Howdy folks, this is Camarda Pans, our worst 5 investments for 2018. If you have any of these, take a special note that the Grinch may be filling up your investment coffers with coal instead of the gold or other things that you might wish. Again, we think investors should be wary of most U.S. stocks and bonds going into 2018. Here are the biggest danger areas in our view. Number one, U.S. large cap stocks, particularly growth and tech stocks, the current market darlings. U.S. large caps have flown high indeed since the market bottom in 2009, eclipsing most of the rest of the world. Now, many of these market corners have not been frothier since 1929 or 1999, years which should have reigned forever in infamy. A couple of fearsome dates to remember, as I'm sure you do. To make this worse, many non-Camarda investors have portfolios chock full of such positions, making the pain of the inevitable correction or bear market potentially far worse than any seen since the great crash of 2008 if you're loaded up on all the same thing and it goes bang down really bad. If you think you might be exposed, and for non-Camarda investors the odds are pretty good you are, contact us for a free portfolio stress test and risk opinion. Number two, FANG stocks, tech darlings like Facebook, Amazon, Netflix, and Google, no Alphabet, are wonderful companies with life-changing innovations. Make no mistake, this is great stuff. Such companies own the future, but that doesn't mean they're worth paying any price for. As I write this, the price-to-earnings ratio on Amazon is over 300, meaning that if the company paid out every nickel that it earns with nothing held back to grow the company or fix the roof, an investor would have their money back on a share of a stock in 300 years. Not so good. Camarda thinks you should stand clear, but be ready to get back in if and when valuations become reasonable again, such as follow the dot-com crash 17 years ago, which, by the way, I remember Yahoo trading, a company that's now kind of in the bywaters of tech companies, but trading at a PE of 700. Oh my goodness. Number three area or investment class to ban and to avoid U.S. bonds maturing in 3 years or longer, including U.S. government or Treasuries, U.S. government agencies like Ginnie Mae or the Freddie Macs, that kind of thing, municipals, and corporates. As interest rates go up, and rates are most assuredly going up, bond prices fall. The risks are insidious, that frog in the pot thing, since A, inflation and interest rates are highly correlated, meaning a fixed interest rate payment on bonds you hold represents a decreasing real return as rates and inflation rise. B, many investors have purchased bonds at premiums, paid more than the price that the bonds will mature to. We find a lot of investors are kind of oblivious to this, by the way, because they weren't sold right. In fact, as a result of abusive sales practices in our view, and a sales pitch based on the coupon yield, this bond's paying 5%, which is the interest divided by the face amount, instead of the probably lower yield to maturity, but since you're paying more than the bond matures to, you're only getting 2%. The coupon payment for the yield to maturity is divided by the price the investor actually paid for the bond. The short of this is that the big hidden losses down the road that we see for legions of investors that have unknowingly overpaid for their bonds. If you have bonds, ding, 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 red alert. Number four, real estate. And I'm talking about investments in physical real estate here, like in rental houses you actually own and have to get sprayed for roaches or have somebody, hopefully not you, clean the toilet. As a long-term investor in rentals, my first rental buy stretching back to 1982 or so, and I've had 100 of them in Jacksonville areas at one point, I've developed a pretty good nose for valuation metrics and a profitable relationship between rental rates and housing prices. Even in a Zillow world, real estate can still be such an inefficient and opaque market. Incredible bargains can be found in even the most bloated markets, kind of like value stocks. The relentless rise in prices since the Great Recession, the everybody's a house flipper popularity of the investment, and the inevitability of interest rate increases, nothing chills real estate values like expensive leverage, tell me to stay away from buying now. If you're getting a good return on what you have, hold on, but consider selling if the tax consequences are manageable. And my 5 worst investment to avoid for 2018, Bitcoin and other speculations. Digital tulip bulbs, anyone? Price run-ups have been dizzying. Most folks don't really understand what these digital currencies are, and finding fair valuations is almost impossible. These are craps table speculations, and in our view, should be very much avoided. Anyway, that's it for now. Wishing you the happiest of holidays. This is Dr. Jeff Camarda. Happy holidays, happy, prosperous, and peaceful New Year to all of you.